Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Friday, January 16th, 2026. We're closing out the week with a look at where institutional and sophisticated capital is actually flowing right now. Actions speak louder than words. Let's follow the money. First up in What's Hot, industrial and logistics, still king. Industrial remains the #1 sector for institutional capital. E-commerce tailwinds continue. Supply chain reshoring is accelerating. Leasing volume is ticking up, driven by manufacturing nearshoring and last-mile distribution demand. Cap rates are tight at 5 to 5.5%, but investors accept it for the stability. Industrial is the defensive play everyone wants. Number 2, multifamily Class B, the consensus trade. We covered this Thursday, but it bears repeating. Workforce housing is where the money is going. Institutional investors are committed to multifamily in 2026, with Class B as the primary target. Value-add strategies are back. The thesis is simple. A structural affordability crisis plus limited new Class B supply equals durable demand. Third on the hot list, data centers. The AI gold rush. Data center investment is exploding. AI and cloud computing demand is driving record leasing. Supply is constrained by power availability and long lead times. Institutional capital is flooding in despite premium pricing. This is the growth play for 2026. Next, and this is a key shift, real estate debt over equity. Debt strategies are outperforming equity and attracting more capital. Senior loans on stabilized assets offer 8 to 10% yields with downside protection. Investors are favoring income and security over speculative appreciation. Credit is the new equity. And finally, for what's hot, secondary markets and the Midwest. Capital is rotating away from coastal gateway markets. Secondary cities in the Midwest and Southeast are winning. Better yields, less competition, and more balanced supply-demand fundamentals. Indianapolis, Columbus, Nashville, and Raleigh are seeing increased institutional interest. Now let's look at what's not. Where is the smart money avoiding? First, and this is no surprise, office. It's still toxic. Yes, prime trophy assets in select markets are trading, but broad office exposure is a no-go. Vacancy remains elevated. Return to office is stabilizing, but not accelerating. Investors want nothing to do with commodity office. Also on the not list, Sunbelt Class A multifamily, because there's just too much supply. We've said it before. Austin, Phoenix, Jacksonville, and Atlanta Class A is a pass. The supply overhang continues. Concessions remain elevated. Smart money is waiting for the washout before re-entering. And finally, high-leverage floating rate deals. Investors are avoiding anything with floating rate debt from 2021-2022 vintages facing rate cap expirations. Distress is emerging. Sophisticated capital is either staying away or positioning as the rescue capital, not the bag holder. So why does all this matter? CRE investment activity is expected to increase 16% in 2026, potentially reaching $562 billion. That's close to pre-pandemic levels. But the capital isn't going everywhere equally. It's concentrated in industrial, Class B multifamily, data centers, and debt strategies. Office and over-leveraged assets are being avoided. Asset selection and market selection matter more than ever. The smart money is defensive, income-focused, and selective. So what's the investor takeaway here? Follow the institutions. Industrial for stability, Class B multifamily for yield, data centers for growth, and debt strategies for income. Avoid office and over-leveraged Sunbelt Class A. Secondary markets offer better risk-adjusted returns than gateway cities. Be selective, be patient, and prioritize income over appreciation. That's how the smart money is playing 2026. That's your Friday Capital Flows update. And that wraps up the week. Thanks for tuning in. Have a great weekend. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter. See you Monday.